Hi, everybody. I'm Kent Daniel. I was honored to be a faculty member here for a few years. I was in the old building in the same suite of offices as Gene, and learned a tremendous amount from him and from everybody else here. And it's really an honor to be back. So I have the task that the organizers gave me of talking about the FAMA French factor portfolios. And exciting, makes me a little nervous. And I'm curious to hear what Gene and Ken's reaction is to all of this. We'll find out. Okay, so yeah, when I mentioned to a few of my colleagues that I would be talking about this topic here, a lot of them laughed, which I'm not sure what that means, but we'll find out. Okay, so I'll throw a lot of stuff out here. What I'm going to talk about is why did this approach become so important, become the dominant way of thinking about asset pricing in the last few decades? And so what's the motivation? And then what have we learned about in terms of improvements on their basic approach, the basic factors? Okay, so what's the goal of asset pricing? Well, as the title states, it's to learn about where asset prices come from. What's the mapping from information into asset prices, okay? The way that the field has predominantly come to look at this because of the influence of Gene and Ken, and also Lars especially, what is the SDF that links prices to future cash flows, okay? So multi-factor models posit that there's a pricing kernel or a projection of the pricing kernel onto the asset return space that explains all returns, okay? And the idea is that we can decompose this projected pricing kernel, this M star, into a set of traded factors that will span the MVE portfolio, okay? And so what this means is that expected returns are going to be a linear function of the betas for that individual asset, okay, with lambdas being the price of risk. So pretty straightforward. This is the motivation, one way of thinking about the motivation for something like the three-factor model regressions, okay? The idea is if these excess returns span the mean variance efficient frontier, then the alpha for every single asset is going to be 0, so we can easily go out and test these by running time series regressions like this one, okay? Now, the question, of course, is how do we discover what this F star is, what these set of returns that span the pricing kernel, and eventually uncover what the pricing kernel is and figure out how that's correlated with macroeconomic risks, okay? So in the early days, there were a bunch of approaches taken on this. One was the approach that was kind of pioneered by Chen, Roll, and Ross, where you go in and you look for innovations in macroeconomic variables. And the idea is these are probably priced, okay? So you find portfolios that are correlated with these macroeconomic risks. And it turns out that didn't really work so well, in the sense that the portfolios that were highly correlated with these macroeconomic variables didn't really produce very high Sharpe ratios, didn't produce large unconditional returns, okay? So that didn't work so well. Connor and Krashik had a different approach, which was to look at the covariance structure of asset returns, okay? And the idea here, which was that maybe the way that assets are packaged into securities and the resulting covariance structure, the principal components, what you get out of by using principal components analysis, maybe those would be priced. Turns out that didn't really work very well either, okay? Now, the economic motivation for that is maybe a little bit weak, but again, something else that didn't work. So then Gene and Ken came along, and they took an entirely different approach, because by the time they wrote their 93 paper, we already knew that there were a few things that seemed to predict excess returns pretty well in the market, namely size and book to market. So they took the approach that let's go in and let's form portfolios excess return portfolios where we go long stuff securities that produce high returns, and we go short securities that produce low returns. And this portfolio, by definition, will have a high return. So therefore, it's got to be correlated with a price factor. Okay? So that was the idea. It turns out this worked really, really well. So this approach that was pioneered by Gene and Ken, and specifically in their two papers, their 93 and their 2015 paper that introduced the 3 and the 5 factor model, is now standard in the asset pricing literature. There are a whole bunch of other factors that have been introduced. I would argue a lot of those probably aren't quite right, but the ones Gene and Ken came up with have proved remarkably robust. And I'm going to talk a little bit about this. This is stuff that I learned from Gene very early on. You use value-weighted portfolios, not equal-weighted portfolios. We'll talk about the reason for that in a minute. They're rebalanced relatively infrequently, i.e. every year. And they're based on sound economic logic, okay? And one of the things that Gene always emphasized is anytime you test these things, you want to go try it without a sample data to really make sure that it's robust, okay? And that's all been done in some of their follow-up papers, okay? So this is where I'm getting a little nervous. So let me talk about the logic behind these factors. So why should book to market work? And the simple answer is, well, if book value is a proxy for the present value of the future cash flows that you're going to get using a certain fixed discount rate, then book to market ratio should be a good proxy for the risk premium that's associated with a particular security. So here's a simple example that illustrates this. What's the firm I's market value? Well, it's the present value of all the future cash flows. Okay, so suppose, let's just create a simple example here. The ROIC, the return on invested capital for all equity capital, is the same across all firms, meaning their future cash flows from now through infinity are just going to be kappa times the value of the book equity. Okay, then the market value of a firm that's a perpetuity. So the market value is going to be that scaled by the discount rate. Just flip that equation around and you get the very nice relationship that the discount rate is linear related to the book to market ratio, okay? So this is a simple argument for why book to market should work. Now that's a little bit complicated because, of course, if the ROIC isn't constant across firms, if some firms are able to produce higher cash flows from the book to market ratio, then other things will matter. And specifically, this is the motivation for Gene and Ken's 5-factor model. If firms produce higher profit for the same level of book, then those firms necessarily have a higher cost of capital. Okay, given this is, by the way, this is straight from their 2015 paper. Okay, and similarly, if you in this equation you hold everything fixed except the required investment, okay, the change in the book value in the future, then a higher investment implies a lower future return, a lower discount rate. Okay. Now, one interesting question going forward is going to be, what are the factors that lead to higher and lower returns on invested capital for these firms? Okay. All right. A minute ago, I mentioned the idea of robustness. Okay. And Gene and Ken's 93 model was based on, as everybody knows, 2 factors: size and book to market. Okay. Interestingly, size is something that I think we've learned over time doesn't really command an unconditional premium, okay? So I put together 2 figures here, and this is, by the way, almost all the data I'm going to use here is straight from Ken's website. So these are Ken's size-sorted portfolios, okay? And you can see here, I've just done a cumulative return plot. And you can see here on the left, this is the cumulative returns of the equal-weighted portfolios, size-sorted portfolios. Okay, and you can see here really strong evidence associated with the size premium. But what's going on here? Well, this is equal-weighted. Okay, so the problem with equal-weighted portfolios is that at the start of every month, what you're putting is an equal dollar amount into every security. Okay? One of the things that we know about, in fact, this goes back to a little bit Antoinette's question a minute ago. Turns out, especially in the early days, there was a lot of negative serial correlation at the monthly return level. Securities would go down a bit, and then they'd bounce back the next day. Part of this was bid-ask bounce. Part of it was just limited liquidity for these securities. So what that meant is, well, if you were running an equal weighted portfolio and the price went down, of course, what you're going to have to do is you're going to have to buy. If the price went up, you'd have to sell to maintain the equal weights. So an equal weighted portfolio has a huge amount of trading going on where you're buying whenever the price goes down and you're selling whenever the price goes up. To the extent that there's any bid-ask bounce or illiquidity effect, that's going to lead to much, much higher estimated returns. But those returns probably couldn't have been achieved because you really couldn't have traded at those prices. Okay? So you can see this blue line, the small firm portfolio, earns really big returns of about 15% per year. But of course, when you equal weight, that brings it down to 11. Or excuse me, when you value weight, okay, which doesn't require the trading, there basically you're not going to have to trade unless there's some corporate event. The returns are much more reasonable. And in fact, if you look at the alphas for these size sorted portfolios, they're all statistically insignificant. Okay. By the way, a neat way to see this in an extreme way is to look at Ken's daily data. And by the way, Dick has an old paper, what Caveat Compounder, I think, that illustrates this. And here are the size sorted portfolio returns, only they're equal weighted daily returns. And you can see now for the small firm decile, the average return is 40% per year, but again, it's ridiculous. You can't earn this because you couldn't have traded at those prices. Okay, so one final comparison. These are now, you'll notice the axes are much more reasonable. These are valuated daily and monthly returns. You can see they're about the same. Why? Because the bid-ask bounce, the illiquidity effects are not causing any problems. Okay, so. Again, one of the things Gene and Ken have always done, in fact, when you talk to anybody about their work, one of the things you know about their work is it's done right, it's always reliable, you can always trust their numbers. Okay, now here what I showed you, okay, size doesn't command an unconditional premium. Do we need to worry about size? Well, size is actually still really important. How come? First off, it's important in explaining the cross-section of realized returns. The size factor is big. And secondly, size interactions are important in describing other premia. Okay? So this is a plot. I'm going to do a lot of plots here. I'm not going to pay a lot of attention to statistical significance, but it turns out these things are statistically significant if you look. These are plots of value and growth portfolios. Only here I'm using Gene and Ken's 25 portfolios that are size and book to market sorted, okay? And this shows for the large cap portfolios, the returns to value and growth. And what you see is there's not much here, okay? In fact, this purple line that I've imposed here, magenta line, is the market. You can see they both basically look like the market. But if you look among small cap firms, so this is the bottom 20% with NYSE breakpoints, what you see is there's a very large effect. This is where you get a really strongly significant effect. Okay? In fact, this line right here is the risk-free asset. And you can see since 1926, that small growth portfolio has underperformed the risk-free asset. Okay, so it's kind of remarkable. Interestingly, one of the things that Ken mentioned is value has not worked since the 1990s. Well, interestingly, if you look at small cap firms, it actually has. Okay, so this is the bottom decile in terms of size, and the solid blue and solid red firms are the value and growth. And you can see we've had performance that's actually fairly consistent. Okay, so why exactly this is happening? This is something John's going to explain in his talk. I'm just kidding. But this is something we need to understand going forward. Okay, let me talk now about just a couple of thoughts on ways these, taking the general motivation for these portfolios, for this approach. how could we make these maybe a little bit better? How should we think about improving these? One is the characteristics that Gene and Ken use in their portfolio sorts are good proxies for expected returns, but not necessarily good proxies for the loading of each firm on the priced factor. Okay, so what do I mean specifically? Well, let's say your model is the following, that the expected return of a given firm is a combination of characteristics, J characteristics, okay, and for each firm there's some characteristic premium. Well, what's going to be the mean variance efficient portfolio? The mean variance efficient portfolio is going to be the combination of those individual assets, okay, the n assets in your universe, okay, which gives you each of these portfolios gives you a certain exposure to the characteristics with the minimum possible variance. Okay? So in other words, these are characteristic efficient versions of the Fama French portfolios. Okay? So we have a paper, myself and some colleagues, Tano Santos, who was a faculty member here for a few years. We propose the use of a set of hedge portfolios, okay, which basically what they do is they go in and they take the Fama French portfolios and try and hedge out the unpriced risk that results when you results because the characteristics are associated, are correlated with unpriced factors. And we show if you can hedge that out, you actually improve the performance of this pretty dramatically, of these portfolios pretty dramatically. In fact, Stefan, with a co-author, has a really nice paper that is a newer and arguably better approach to building these characteristic efficient portfolios. So one of the things that we've learned is that maybe controlling more accurately reducing the risk of these portfolios using information about the covariance structure can be helpful. One other thing I wanted to talk about here is the use of book to market. Okay, this is a plot again from Ken's data of Tobin's Q for the U.S. market. So in other words, the ratio of the market value of all the firms in the U.S. market to the book value of all the firms in the U.S. market. Okay, and you see this pretty striking change over time that if you go back, in fact, to the 1930s, the ratio of the market value to the book value of U.S. firms was about 0.47. Okay, if we go more recently, we're at about a little over 4. Okay, so that's a pretty striking change. What has happened? Well, firms are different. The argument that I know Mike is working on this, a bunch of other people are working on this. Basically, there's a lot of firms' value that is not captured by book. Okay, there's been an attempt, partly in the accounting literature, partly in the economics literature, to figure out what is the value of the capital that is not captured by the standard measures of book. Okay, and there's in fact been some work to incorporate this into measures of book to market. So in other words, let's adjust book value for organizational capital and knowledge capital that is embedded in firms. Okay, then we can remeasure book to market. Okay, and better explain the discount rates, the prices of firms. Okay. So this is again, I'm going to use some plots to illustrate this. Here we've got the risk-free asset is the blue line. The blue and magenta lines are the market. This is the standard book-to-market factor, HML. Okay, and here what I've done is I've broken that up. I haven't made the intangible adjustment yet, but I've broken this up into large cap and small cap book-to-market portfolios, as I did earlier. And now what I'm going to do is I'm going to adjust those for intangibles. Okay, now interestingly, this adjustment doesn't affect the large cap returns very much, but it turns out when you build a small cap book-to-market portfolio and you take account of intangible adjustments, you get a really large increase in the expected return and in the Sharpe ratio. In fact, the t statistic on this over this period is about 5. So it's a really dramatic improvement. The last thing I thought I'd talk about, I'm running out of time here, is the evolution of borrow costs. So one of the things that maybe we've assumed here is that it's easy to go in and short certain kinds of firms. And it turns out this is kind of a striking thing in modern financial markets. This is all data that comes from Markit, the data provider, M-A-R-K-I-T. And here what I've done is for the size portfolios, I've plotted the borrow costs for those value-weighted size portfolios. And you can see we've had this striking phenomena since the data become available, which is in 2006, okay? We've seen that for very, very small firms, the borrow costs have gone up in a really dramatic way. In fact, there are periods right at the start of the pandemic where we've got average borrow costs for small decile firms that are above 12% a year. Okay? Now, if you're somebody who's holding these small cap firms, it's actually an advantage. If you're an institution, you can lend these out and you can capture the borrow costs. But if you want to go short, you have to pay that borrow cost to hold these. Okay? Let me actually skip over this. This shows for the small and big portfolios, okay, that Gene and Ken developed. These are the borrow costs associated with those portfolios. And you can see again that the average borrow cost for the small portfolio is a bit over 1%, okay, and has increased a little bit recently. Well, in fact, if you're going long these and you're an institution, you can capture that borrow cost. You can see it's far, far lower for the large cap portfolio. And finally, this is kind of an interesting thing. I'm not sure what to make of this. Again, I'm counting on John to explain this. But if you look at the value portfolio and the growth portfolio as defined by Fama and French, what you see is there's kind of most of the time, the borrow cost associated with the growth portfolio is higher, which at some level is what you'd expect as you think, these are firms that have at least on average had a lower realized return, okay? But strikingly, at the just preceding the kind of the meme stock frenzy of 2021, there were really, really high borrow costs associated with the value stocks. Okay, so in summary, there are a lot of really interesting open questions. But again, we were talking just before this session with Toby and I with Gene, what have we really learned from all of this? Well, I think we've learned how, not necessarily what the answers to all of these questions are, but we've certainly learned an awful lot about how to ask the questions and how to think about the questions. All right, thank you.
Okay, so this seems very loud. So, let me just point out, I was a student here at the University of Chicago in the economics department, and my thesis committee was Lars Hansen, Bob Lucas, and John Cochran. And actually, it was funny when just a shout out to Lars. So I wrote my dissertation, and I don't think Lucas actually read it. But he said, "Is this okay with Lars?" And I said, "Yeah, it's fine with him." Then okay, it's good. Then so that, and to my detriment, one thing I hate to admit is I never took a class at the GSB. So until I came here as a Gene's colleague, I didn't have the pleasure I didn't take the opportunity to learn from him, and I've obviously learned a lot from him and all of my colleagues here since my time here. During my time here. Okay, so this is supposed to be about asset prices in the economy. And Kent talked about asset prices, and I guess a little bit about the economy through intangibles. And there's no way I'm going to explain anything. I have one figure, unlike Kent. So I've got a bunch of stuff that there's some theory that sure will explain all this stuff, Kent. But let me just talk about some of the evolution here. So asset prices in the economy, when when Anil asked me to talk about stuff, he said, really, I would focus a little bit on what largest contributions, but I'm going to do it a little more broadly here. So this is obviously a huge area, and there's macro factors generating risk premia, cost of capital and investment. How do we think about the impact of monetary policy, financial institutions? Many important contributions here at the University of Chicago and elsewhere, of course. And so I can't overview all these contributions. And I'm gonna, even if I try to talk about significant ones, that's too big a list here at the university. So I'm gonna just focus on stuff I know. So that's kind of what I'll talk about. And my apologies in advance. I'm not gonna mention all my colleagues. I love all of you, all the contributions, both here at Chicago and elsewhere. Okay, so this is what Kent just talked about, really. We have this pricing kernel. We're trying to price, and I'm going to write this as price instead of talking about excess returns. We have price of security should be expected value, this pricing kernel discounting times some payoff. And there's a FT up there which tells us about information. So, no arbitrage would just say, well, let's look in the space of returns. Sort of traditionally, let's look in the space of returns for pricing, and we know from no arbitrage kind of arguments that will exist. And the question is, how do we reduce the dimensionality of that? And that's kind of what Kent was talking about in terms of Kent and Gene's work. So the economic models, of course, would link more broadly MT, XT, the information flows, everything, to economic events and potentially economic quantities outside of the financial markets, right? So that's sort of the macroeconomics, and asset pricing would just say, okay, there's some structure a priori perhaps that links this pricing and the payoffs and the information structure. Okay, so the classic thing, of course, would be the consumption cap BAM, Lucas, Breeden, others. Not, obviously we talk about often attributed to these two authors, but obviously many other contributions elsewhere. So under a simple setting, we have a classic sort of maybe straw man kind of model. We have a CRA utility function, and it links consumption and two parameters, beta and gamma, to this pricing kernel. Okay, so then there's of course this issue, like how the hell do we measure consumption? Do we really want to use aggregates that are mismeasured or they're not representative, so on. Okay, so if you think about the whole dynamics there, one approach, of course, in the literature, like in Hansen and Singleton in their JPE paper, they said, look, let's write down a model for the joint distribution of returns, say, and aggregate consumption, right? And so this is conditionally normal. In their model, it's kind of a linear setup. But we could think about those moments for the means, the vector of mean returns, and mean returns of mean consumption growth, having some time variation potentially in it, and potentially time variation in the covariance structure as well, of those things. So we get, of course, this linkage. The risk-free rate is driven by these parameters, gamma and beta. And the first term is just kind of pure rate of time preference, and then a growth term, and a term involving precautionary demand, if you like, volatility. And then X returns, or excess returns, is subtract the risk-free rate, would be driven by, unfortunately in this log case, there'd be a volatility term you have to account for, but then this covariance between consumption and returns. Okay, so this setup, as in Hansen and Singleton, they said, look, this puts a joint restriction on these dynamics. Okay, we can go out and look at that whole restriction on the conditional means and driven by the conditional covariances. Okay, all right, and so if you think about generally, what we're trying to do is price shocks to consumption, and those shocks could be driven by monetary policy. They could be driven by all sorts of things. So we want to think about a vector of shocks hitting the economy. And so it's kind of, we want to think about this covariance between returns and the shocks to in this kind of models, kind of instantaneous consumption. Now, of course, the problem is, okay, great, go look at that data, and I'll show you one figure, which are book to mark sort of portfolios, 5 of them. Those measured covariances, say on a quarterly basis, they don't vary very much across securities. So, it's hard to, okay, great, you can go out and measure them, but you don't see much data. Now, we have to be a little careful because it's like conditional moments and so on. So there's been some discussion in the literature about, well, maybe those conditional volatilities are moving around. There might be large events, sort of peso type problems, so you don't see extreme events in the data that might explain some of this. Okay. Now, of course, we could go as in Hansen and Singleton in their econometrica paper, implementing Lars's GMM ideas, say, look, we don't have to linearize this model. We could always leave it in its original nonlinear form and estimate the 2 parameters beta and gamma based on just the conditional expectation of the error term has to be 0. Whoops, there should be minus a price over here, minus 1 over here for the actual error. Okay, so this, of course, is important in its own right in macro, right? So in macroeconomics, a link to asset pricing is like, why do we look in this space? You look in this space because it helps you identify important parameters for how the economy is going to respond to things like this. Gamma affects intertemporal decisions, how people respond, say, to changes in interest rates, that effect that might have on aggregate consumption. So there's been, quite important discussion about what are the appropriate values for these parameters. Are we identifying risk aversion? Are we identifying intertemporal demands, and so on? Of course, this model, the way it's written, is over-identified because there's lots of moments that we could use. And when you look at those over-identifying conditions, you kind of blow the model out of the water, again, because there's not enough cross-sectional variation in these covariances. Okay, so similar literature, of course, in investment, physical investment, looks at the same type of first order conditions, right? So for demand, like in Tobin's Q kind of ideas, and we see the similar kind of slow response or non-response. Tobin's Q moves, the relative value of capital replacement values versus the futures. If that's high, there's high future value, we expect investment to respond dramatically, and we don't see that quickly. And that's, of course, the response to that is say, hey, wait a minute, we ought to enrich the model to allow for things like adjustment costs, potentially heterogeneous behavior across firms because they face different constraints and so on, to help us understand that. So this idea of, as we'll talk about some more about, there's other frictions or other things going on that's disturbing the contemporaneous variation we see in physical markets as well, besides financial markets. So same sort of issues. By the way, John Cochran in 1991 and then more recently in 2020 in a paper, he basically says, look, the same idea about margin rates of transformation over time and potentially across states in the production function gives us an alternative, if you like, an alternative model for pricing where we link investment behavior, physical investment behavior to pricing. Okay, so the literature, of course, has said, okay, well, this straitjacket of the CRA model has problems because we don't see a lot of variation at in consumption to explain either differences in average returns or predictability, like time-varying risk premia. So is there evidence for that time-varying risk premia? The answer is yeah. I think Ken was talking about why is there excess volatility? Because of time-varying required returns or time-varying expected returns. Okay, so there are a set of papers, of course, and since I'm giving the talk, I could mention one of my own papers, but anyway, so major works here, but George Constantinides, I don't see George here, but George had a very important paper in 1990 outlining sort of a habit model and quite a nice insight about how you could get with habits sort of different, slower responses of consumption, and then having risk aversion move because of lag consumption. And then Campbell and Cochran kind of take this sort of setting and show with a very simple set of an endowment model that even with not predictable consumption, you can get some substantial time variation in expected returns, high risk premia, and so on. There's other models out there that try to do similar things, models of like Epstein-Zinn, Krebs-Porteous kind of preferences, recursive preferences, and I'll come back to this ambiguity aversion ideas due to Lars and Hansen and Sargent and others. So what these models apply, a very, very interesting dimension, is say, well, maybe short term we're having trouble with risk premia, but let's look at the temporal dimensions that might be there in risk premia. And people like Ralph, for example, here looked at those temporal dimensions, try to argue that puts restrictions on what these risk premia time variations should look like. Okay, so there's also then this literature that says, okay, maybe we want to think about risk more flexibly. You know, do we really just want to look at contemporaneous variation? Similar to the investment corner literature that says, oh, there's adjustment costs. So instantaneous responses, even at quarterly horizons, probably not reasonable. You know, so as a diagnostic or trying to understand things sort of pulled away potentially from frictions or short-run behavioral effects. And I'm not arguing that behavioral effects are just short run, okay? But if you think about sort of longer run components might matter. So Hansen and Schenkman and Hansen in 2012 have these built out ideas of how you might identify that low frequency component that's important for returns, okay? So I have a paper with Lars and with Nan Lee in the JPE where we look at the covariance of these shocks to long-run consumption and book-to-market returns, for example. And we see variation there that you don't get if you just look at the contemporaneous ones. Okay, so in another paper, in a handbook paper with, that's the wrong Lee, spelled wrong, L-E-E there, that should be L-E-E, not Nanley, and Nick Ruzanoff, we have a handbook paper that looks, one of the figures in the paper says, okay, fit some dynamics to consumption, use some other variables to forecast, and throw in the book-to-market returns as part of your forecasting, okay? And so look at those shocks to these returns and how they co-vary with future consumption. And you see sort of a bit of a glimmer of, okay, this can work. This is in Parker and Juilliard, by the way. So you can see what this is it shows, number 5 there is the things with high returns, low book-to-market portfolios, high book-to-market portfolios, value portfolios. They have higher covariances with consumption growth as you go farther, and whereas growthy portfolios don't. So that would be some evidence that this lower frequency component matters. Yeah, literally the model has trouble right here, because there's no differential in the covariances, but there's some idea that lower frequency components kind of are more important. Okay, so talking some more about thinking about shocks. So we're going to think about these conditional covariances. Linear models kind of tie your hand, and there's potentially important nonlinearities. In particular, if you think about bad states of the world, those covariances probably are shifting, or people's attitudes towards those risks are shifting, okay? So how do you think about in those worlds shock effects? Like this is like a classic VAR kind of thing where you look at, you measure things as up to time, this impulse, and then just run the VAR forward, the predictions forward to talk about how shocks propagate. So Lars has some papers that tries to think about, okay, well, how do we want to measure kind of importance of these nonlinear effects? And they have this methods for trying to talk about shock, what they call shock elasticities, but it's really trying to say, hey, in different states of the world, how does the economy respond to that? The other thing is that perhaps, we do stuff like this, we're using historical data and estimating statistically things as if the agents know that statistical history. There's no classical, I'm sure Lars will talk about later, no classical sort of uncertainty about what is the actual structure. Like how the hell do we even know it's a VAR of order 10 or 5 or whatever we're fitting? And Lars has a very nice survey, which I hadn't appreciated until I was on the plane last night reading. I apologize, Lars, that I never read it before. But anyways, bad colleague, bad student, bad colleague. So he has this very nice survey paper. And it's quite clear. It's very nice. Typical Lars, it's like, here's a couple of examples. And they're not meant to display and fix the world and cure cancer. They're meant to illustrate a mechanism. And he has this nice example where I suspect he'll talk about this some more later, but sort of these spillovers of uncertainty, where what he means in that world is that agents really don't understand the perfect structure. They have prior, if you like, over multiple different worlds. And so there's some sort of ambiguity across these models, classic ambiguity, or potentially there's misspecification in the models. And the way investors think about risk there are driven by analysis from decision theory. And what's interesting is it creates this uncertainty about long-run forces, which are sort of intuitive. And the other thing is in bad states, that uncertainty can rise quite dramatically, right? And so you can get, again, if you step outside of the straitjacket of the sort of linear fits to models or the data, you can get these longer run effects that are quite substantial and maybe quite reasonable, reflecting a sort of a broader view of how people are responding to shocks. Okay, so who's in charge of this session? So I'm paying $0 for this? You saying that's the price of this talk? Okay, all right. So. Okay, there's a Neil. So here's a pot shot, I guess, at some of my colleagues in macro. I'm also a macroeconomist. I think sometimes in macro, people kind of ignore the financial markets. So they might do Tobin's Q, but risk premia and implied dynamics for security prices are kind of sometimes ignored. So for example, think about the massive run-up in the stock market that we've recently witnessed. We don't see a physical investment responding. Perhaps that's intangible, but it's an important mechanism. Now, recent models, though, if you think about some of the new Keynesian ones that are closest to things I think about, is they've added heterogeneity in incomplete markets, and they are taking asset markets more seriously, because you got to kind of try to look out to see where those constraints might be and so on. So we've known for quite a while that the dynamics of the wealth distribution matter. So a classic example would be Constantinides and Duffy, sort of this possibility result about how the wealth distribution shifting over time can really change the way assets are priced. I have a paper with Debbie Lucas, JP, about the same time. What we show is quantitatively the importance of the distribution, but also where people are against frictions. So the frictions in the market really matter. So trying to measure those are quite important. So there's some new Keynesian models. So one of my junior colleagues here are trying to think about, jointly that cross-sectional distribution and then how people respond to, say, monetary policy shocks. And it gets different depending if people are against constraints. So if they're against constraints, they can't respond. They're just consuming out of pocket, versus in states of the world where they're not against the constraints, you get a much smoother response. So what's happening in these kind of models, quite interesting, is another source of variation that perhaps we ignore is this variation in the wealth distribution. Now, one problem, well, first, the good thing is in a earlier paper by myself and Debbie Lucas, we do show that, if you look at the wealthy part of the distribution, non-traded income, not labor income, but, and Eric Zwick will probably correct me, he says this could still be labor income, John, just connected to capital. that source of variation for the wealthy seems to affect their portfolio decisions, not surprisingly. And the factor that comes out of that seems to price some of the variation that we see. Now, one problem with this is that one problem with these kind of models that do this is you end up with another set of moments you got to look at, which is the wealth distribution. And I think, unfortunately, some of them don't necessarily address the concentration of wealth. So, and I don't mean from a normative sense, I mean from a positive sense. Like we know that the wealth distribution is quite concentrated, so we really care about kind of the dynamics of that wealth distribution, and it's very slow moving. So some of the mechanisms in these models rely on the wealth distribution moving around a lot and don't address the upper end. Now, some of my junior colleagues, Eric Zwick and some of his colleagues or his co-authors are looking at, examining that, trying to understand those dynamics a little bit better. Part of that, I think, is for tax policy, but I think also from my perspective is trying to understand those other risks. How do we think about it? And I guess what I like is that research is happening and hope it continues. So that's it.
I'm Toby Moskowitz. You'll hear from me later, but just one question I had that Kent mentioned and John, you alluded to was in thinking about this intangible piece and people starting to look at this with respect to value. We think of that as maybe an economic variable that has some content to it, right? At the same time, if you remove the unhedged risk, some of your work, Kent, you find that these factors look a little better. But I think it'd be interesting to kind of combine those two things. So for instance, one unhedged risk that I think people have recognized is industry risk, right? You take that out, book to market looks better. Also turns out that intangibles don't matter as much when you do that either. So they're sort of picking up the same piece, but they have different interpretations. I'm just wondering if there's any work that's ongoing now that's trying to connect those two things, putting some one's coming at it from a statistical perspective, that's how you find the unhedged risk. The other is putting some economic structure to it, but it seems like an interesting area.
Yeah, so my take on this, exactly right. Why do intangibles matter in forecasting returns, as we've seen? The argument would be, well, you can't have just intangibles are more important in every single firm. The answer is some firms are different. Some firms have a lot of intangibles, some firms have very few, and if we just look at straight book value, we're not going to capture that difference. A lot of that difference between firms is something that is an industry effect, right? In other words, some industries are necessarily going to have a lot of intangible, other industries are going to have less. In fact, arguably, maybe this is why we find industry book to market is, industry adjusted book to market works better than not industry adjusted book to market. So I think all of these things are linked, and I think, as far as I'm aware, nobody's actively looking at this, but it seems like a great area for future research. All right? Thank you very much. Thanks.